Hi there. Many UK families worry about inheritance tax bills. In this video, we explain how life insurance can cover IHT and why putting policies in trust matters.
Hello and welcome. Here at My Tax Accountant, our whole goal is to make UK tax simple so you can make smarter financial decisions. And today, we're diving into something that's a huge financial blind spot for so many families: what really happens to your life insurance payout and how one simple step can shield it from a massive, unexpected tax bill. It's a comforting thought, isn't it? You've done the responsible thing. You've taken out life insurance to protect the people you love, and you just assume that they'll get the full amount. No questions asked, no strings attached. But, as we're about to see, the reality can be very, very different. That's right. Without one crucial, simple step, the very money that's meant to secure your family's future could actually be slapped with a 40% inheritance tax bill. That's a huge chunk of their financial safety net just gone. Okay, so here's how we're going to break it down. First, we'll expose that hidden tax trap and look at exactly why your payout is at risk. Then, we'll get to the solution, a simple trust, and we'll walk through how it works, how easy it is to set one up, and what your next step should be. Right, first things first, we need to get our heads around inheritance tax, or IHT as it's known. It's a tax that's catching more and more ordinary families out, mainly because the tax-free limits haven't moved in years. So here's the deal. Everyone gets a tax-free allowance of £325,000. That's called the nil rate band. You might also get an extra £175,000 if you pass your main home to your kids or grandkids. That means a couple could potentially pass on up to £1 million tax-free. But, and this is the crucial bit, these limits are frozen solid. So, as the value of everything else, homes, investments, creeps up, more and more estates are being dragged over the limit and into that 40% tax bracket. Let's make this really clear with an example. So, let's imagine a guy named David. His estate, his house, savings, the lot is worth £400,000. He does the right thing and takes out a life insurance policy for 250,000 quid for his kids. But because he misses one simple step, that payout gets lumped in with his estate. Suddenly, its value shoots up to $650,000. After his tax-free allowance, that leaves $325,000 exposed to tax. The result? A massive, and I mean completely avoidable tax bill of £130,000. Just wow. And believe it or not, it actually gets worse. It's not just about the tax bill itself. When you don't plan for this, you create a perfect storm of financial pressure for your family, right when they're at their most vulnerable. Okay, so you get hit twice. This is the double hit. First, there's that massive 40% tax. But second, there's the delay. The entire estate, including that insurance money, gets frozen until a legal process called probate is granted. And that can take months, sometimes even a year. Now here's the real cash flow crunch. The tax man wants his money within 6 months, often before your family can even get their hands on the funds from the estate. So they're literally left scrambling to find the money to pay a huge tax bill on money they technically have but can't even get to. It's a nightmare scenario. All right, time for a quick did you know moment. In just one tax year, families in the UK paid an estimated £346 million in inheritance tax on life insurance payouts that they never needed to pay. Let that sink in for a second. That's money that should have gone to families, not to the tax man. And you know, behind a number that big, there are real people. We're talking about nearly 7,500 families who saw their loved one's legacy shrink, all because of a tax that, in pretty much every single case, could have been avoided with some simple planning. And this whole issue is only going to get bigger. Right now, your pension pot is generally kept separate from your estate and it's safe from inheritance tax. But from April 2027, the rules are changing. Unused pension funds will start being counted as part of your estate. For a lot of people, their pension is their biggest asset after their home. This change is going to push thousands more estates over that tax-free limit, making the kind of planning we're talking about today absolutely critical. Okay, so after all that doom and gloom, what on earth is the solution? Well, thankfully, it's actually surprisingly simple. It's a legal tool that basically puts a protective wrapper around your life insurance policy. It's called a life insurance trust, and all it does is create a clear legal separation between your life insurance policy and all your other assets, what's known as your estate. Honestly, the best way to picture it is like a financial safety deposit box. You just pop the policy inside, and whatever's in there, the big payout, is completely ring-fenced and protected for your beneficiaries. And there are only 3 key players involved. First, there's you, You're called the settler because, well, you're the one setting it all up. Then you appoint trustees, usually 2 or more people you really rely on, like family or close friends, to manage it. And finally, you name the beneficiaries, the people you actually want the money to go to. See, it's that simple.
So how does this one simple little change in ownership make such a massive difference to the outcome? Let's break down the core benefits. Look, the difference here is literally night and day. Without a trust, the payout is part of your estate, it can get taxed at 40%, and it's locked up for months in probate. But with a trust, the payout is completely outside your estate, it's shielded from IHT, and it bypasses probate altogether. So your family gets the money in a matter of weeks, not months or years. They get the full amount, and they get it fast.
You know, there's this big myth that trusts are these super complicated legal tools that are only for the mega rich. It's just not true. When it comes to life insurance, a trust is a standard, smart planning tool for any family who wants to make sure their legacy doesn't get eroded by a tax that was completely preventable.
Now at this point, you're probably thinking, okay, this sounds complicated, it sounds expensive, but the reality is, for life insurance, it's just a simple administrative step, and in most cases, the forms are provided for free by your insurance company. Okay, so here's the process, and it really is straightforward. You start with your policy, and then you choose the type of trust. A discretionary trust is the most common because it gives you a lot of flexibility. Next, you appoint at least 2 trustees you trust to manage things, and then you name your beneficiaries. Finally, you all complete and sign the trust form, get it witnessed, and that's it. It's official. It can often be that simple. Okay, and here's a little professional tip for you. If you pay your policy premiums out of your regular surplus income, so money you don't actually need for your normal day-to-day living, those payments can often be treated as IHT-free gifts. It's a really powerful exemption that makes this whole strategy even more tax efficient. So, we've covered the problem, the potentially devastating consequences, and the simple, incredibly effective solution. Now let's talk about how you can take control of your own financial legacy. I want you to just think about this for a moment. One simple form, which again is often provided for free by your insurer, is the only thing standing between 2 very different futures for your family. One where they get the full payout quickly and without hassle, and another where they lose up to 40% of it to tax after months of stress and delay. It is genuinely one of the most impactful financial decisions you can make.
If you want to explore how this applies to your specific situation, or if you need any help with your tax planning, please do get in touch with us here at My Tax Accountant. You can give us a call on 020-8570-8531 or drop an email to info@mytaxaccountant.co.uk. And just a quick but important disclaimer, this explainer is for general guidance only. Tax rules can and do change, and everything depends on your individual circumstances, so you should always seek advice from a qualified professional.
So, the final question is, are you ready to make sure the legacy you're working so hard to build is fully protected? For more essential explainers that help you navigate the UK tax system, make sure you subscribe to the My Tax Accountant channel. Thanks so much for watching.